Welcome back to another episode of Gimme Some Truth. Clint and Sil and I are going to talk about Q3 recap, maybe even a little bit into Q4. We get asked this quite a bit by clients that say, hey, just what are your thoughts on what's going on right now? Obviously, it seems like there's a lot going on always, right? I mean, it doesn't seem like there's a time when there's not a lot going on, but for some reason, and we can all have our own viewpoints as to why there's a lot going on right now. So let's get into it and talk just in terms of maybe what happened to this point. Sil, as we like to brag on his behalf, our resident CFA, what happened in the third quarter? What stood out to you? What was something that maybe you didn't think was going to happen that did happen?
Well, I think we saw a continuation of a very strong rebound off of the lows we had earlier in the year. So I don't personally find it very surprising. I think there was clearly a lot of momentum behind this rebound. And we've seen continuation of that, right? So We've seen a continuation of the same theme that we saw developing at the end of Q2. And really, it's just building into Q3 with just more of that same momentum. So it's been nice to see. It's been a great quarter for investors. And if we look at the numbers at the end of the quarter, I think the performance has been pretty spectacular. I mean, if you look at some of the data that we have on the board here, S&P plus 5%, the Dow plus 3%. So these are great quarterly numbers. So it's been nice to see.
Well, even globally.
Yeah.
Europe,
absolutely.
And that's impressive.
That's probably one of the big stories of the year is for the first time in a long time, we're starting to see international stocks actually do really well, do even better than U.S. stocks. Yeah. So I think, and that's been great because it's been, an area where we've had a pretty strong conviction for a long time. And for a while, it didn't work out. And this year, it's like, everybody wants to be invested in international stocks. And I think there's good reasons for that. I think it's still an area where, valuations are cheaper and potentially more attractive. So I think for a long time, we talked about this idea of seeing a broadening of the rally. So seeing a rally that isn't just centered around, the U.S. and the large U.S. tech stocks and seeing, more of different sectors and different types of stocks participating in this rally, but it never seemed to happen, right? And I think this year we're starting to see signs that we're getting this broader rally with international stocks doing better, emerging markets doing better, even signs that things like small caps here in the U.S. are coming to life a little bit.
Yeah.
So I think that's kind of a big underlying theme that I'm seeing in this market now that could potentially continue into Q4.
Clint, we hear the word resilient used all the time, and for good reason, to Sil's point. It seems like if you're going to use a boxing analogy, right, the economy is able to kind of take the body blows and just keep going. It doesn't really seem like there's a lot that has pushed the momentum, shaken the momentum. I mean, obviously the tariffs when they first kind of rolled out, March, April was a little bit scary for people, but boy, since then, resilient.
Very resilient. The tariffs have brought in a significant amount of revenue. One of the sort of thoughts around that is what we were going to see an ignition of inflation.
Yep.
To this point, we haven't really seen that too much. We might have embers going, but we haven't seen it ignite. So I think that's helped a lot of investors cool down a little bit and take a look at it. And Sil's absolutely right about the momentum part of it. It seems like the momentum is just picking up instead of dissipating. And, you can have some concerns about valuations that I think are valid. We can discuss that a bit. Obviously, there's a signal going on out there too. Year to date, gold is up 40%. What does that mean? There's something that's telling us. The Fed has cut rates. They're talking about cutting rates further. So you see some of these like flashing yellow lights up there and you're wondering what's going on here. But as Sil has said time and time again when I talk to him, he's always like, momentum is your friend. So, it just seems to continue to perpetrate through the economy. This sort of AI trade, this momentum is continuing and persisting so far through quarter three.
Yeah, and beyond just AI, right? I think Sil brings up a great point. We're starting to see it broaden, and I think that's what a lot of investors have been waiting for a while. I'll put you in a difficult position, Sil. Tomorrow, you're Fed chair. What would you do between now and the end of the year? Do you think anything needs to be done? Do you think the Fed is playing this correctly? I mean, kind of help us understand. I mean, it's such a bizarre time when the color beige gets its time in the spotlight, and that's kind of what the Fed is, right? Every once in a while, like the Fed just gets all the energy,
right?
And you're like, it's such a boring thing, but it's once in a while, right? I mean, they get their time in the sun, and then they're getting it now.
I mean, you don't want me as Fed chairman, first of all. Let me tell you that, because that probably raised interest rates. But so let's get that out of the way. That's what I would do. But that's not what's going to happen. What's going to happen is, we're going to see lower interest rates between now and year end. And I think it's interesting because, we are cutting interest rates at a time when, the economy is not in recession, right? You talked about the economy being very resilient. It's strong. It's taken the blows, but it's got a good chin. And, I think it's a continuation of what we saw basically since, COVID, and since 2008, where, we are continuing these policies of low interest rate almost by default, right? So interest rates are going to be lower. We're also going to see more government spending. And, we're seeing that with the new budget bill. We're going to see this continuation of a theme of easy money and, government spending, even at a time when the economy in itself really doesn't feel like it needs a lot of stimulus, but we're still in stimulus mode. So, the market loves this narrative of easy money and government stimulus. And so, I think that's part of the reason markets are doing so well this year. Is it fundamentally good policy long term? I don't know. You could debate that. But I think if we've learned anything from the last few years of price action, is that the market responds really well to those kind of narratives. So I expect that to continue.
With the fear, right, of inflation, right? I mean, that seems like it's always kind of right around the corner, but it doesn't seem like it doesn't seem like that is gaining momentum, right? It seems like that's kind of, it's not stuck in neutral, but it's not really gaining momentum, right? It kind of is somewhere in the middle of those two.
Yeah, I think, and Clint mentioned gold being up 40% year to date. I mean, it's clear that we live in a world where a lot of people are speculating around the idea and looking to position themselves for the possibility that the dollar may not remain the world reserve currency forever. And I think they look around for good candidates to replace or at least diversify away from the dollar. And I think there's a lot of potential candidates, right? You could look at the euro, you could look at other currencies, you could look at Bitcoin if you want, but gold is a great candidate, right? And I think we're seeing that. We're seeing gold kind of get back a lot of the monetary role that it's traditionally had in the global financial system. And I expect that to continue. And I think it does tell a story in terms of currency weakness, right? Which you can call inflation, but is ultimately just currency weakness. And, I think you can't ignore those signs.
Right.
Yeah.
I think if you're over 50, you're buying gold. If you're under 50, you're buying Bitcoin. And that's kind of what it seems to be happening. But it is still telling the same type of story, right? Which is, will the dollar continue its dominance? And, I think the answer is probably yes, but the dollar nonetheless has fallen. It's fallen a lot this year. That gives the currency conversion also for the international stocks. That's another reason why it's performing so well. I think the U.S. story, just in my view, the U.S. story is better than the international story, but international stocks, as Sil alluded to, still appear to be undervalued relative to U.S. We've said that for a really long time. And then with the sort of dollar weakness too, you get that little cream on top. So it has balanced out the returns across equities. And so I think that's been a great kind of fun story to see in 2025, that shake out. And I think that this is, our GDP numbers are just like we were revised up to 3.8% in quarter two, looking like we're slowing a little bit in Q3, but still at 3%. I mean, if we would have said this 2 or 3 years ago and talked about growth numbers and we'd say we were north of 3%, I mean, we would all be high-fiving each other and being like, this is the great economic boom that we've been kind of waiting to unlock. And so these GDP numbers are fantastic. And to Sill's point is to pump more stimulus on top of that.
Right.
It's a little concerning
Yeah.
in itself. And I kind of share your view there, Sill. Like the economy's pretty hot right now. Jobs numbers are still pretty good overall when we're supposed to be really reducing headcount. You know, the government's reduced headcount, and you know, you see these AI could be reducing headcounts as well, but we're still in like this sort of like ultra stimulus mode. So it's kind of an interesting dichotomy going on. The economy right now is extremely complex. I think that's what we can kind of see right there is it's not just as simple as cutting an interest rate, although that's the simple narrative we get sometimes. But this economy is extremely complex, but pretty exciting too. There's a lot of great things going on, and companies are doing very well. Earnings have held up. I mean, we look at the earnings reports, fantastic earnings.
Profit margins are about as high as they've ever been. So corporate America is doing great. Look at the S&P 500 profit margins. They are at all-time highs or hovering around all-time highs. So companies are extremely, extremely healthy. And that's a big part of why even things like tariffs, you know, if there's ever a time when companies can absorb a lot of tariff costs, now is the time, right? And I think that's a big part of why, you know, market already looks like it's moving on from that theme. Because companies are so incredibly healthy. They can afford it. If you look at individual balance sheets also in the US, you know, people are, you know, doing pretty well. Debt servicing costs are pretty low by historical standards. So I think there's a lot of reasons why, you know, the economy's continued to do reasonably well despite, you know, all the scary headlines.
Yeah, I think that the American consumer is obviously a huge part of it. I mean, 70% of the economy is consumer spending, right? So I mean, it's a huge aspect of the economy, and mortgage rates, you know, switching into you know, residential and the American consumer, and even the global consumer, frankly, because there's a lot of people that a lot of clients we have that still own real estate in the U.S. You know, peaked over 7. The 30-year fixed earlier this year in January. Now it's somewhere between 6.2, 6.3. Chance that they even get below 6 here before the end of the year. We'll kind of see where it goes. Obviously, those are tied more to the 10-year Treasury than what the Fed's doing. But you know, that even strengthens even other areas of the economy. Refinances are actually a thing again, which wasn't the case for 3-4 years. Interesting. It's just an interesting time right now. I think Clint brings up a great point. It's complex in a way that I don't think we've seen historically for a long time, with some of these aspects converging together at the same time. I mean, it's just as you said, I wouldn't want to be Jerome Powell right now.
It's
I mean, you're getting beat on pretty often too.
Yeah,
like
even that, or just like, how do you make the right call? What is the right call?
It's true.
Who's to say, right? I mean, I think you could make an argument that lowering is the right call, holding steady is the right call, and raising is the right call. Right. I mean, it's just a weird time to be.
Absolutely. And it's true. It's very complex. There's a lot of changes happening, even like AI, right? The main theme that's driving a lot of the discussions, you know, is it good for the economy because, you know, we're building data centers and stuff like that, and we're improving productivity? Is it bad for the economy because it's going to cost jobs? You know, who knows, right? The reality is it's probably going to be somewhere in between, but you know, it's going to change the landscape. We just don't know exactly how.
Let's switch gears here in our last few minutes. Q4. Kind of what do we think, Clint? What do we think just in terms of big themes, right? I mean, not day-to-day movements. I mean, obviously that's really hard to predict. I mean, obviously we're recording this on September 30th. So will the government be open tomorrow, right? I mean, I guess this is a big theme to talk about for Q4. So what are the big themes for Q4?
Well, if you're looking at the prediction markets, they would say, no, it's not open tomorrow for sure.
It's not going to be open tomorrow.
Yeah. You know,
and that's not even true. Government will be open. However, it will likely be day one of a shutdown.
We've seen this movie before. Right. Yeah, I mean, going into this, I echo what Sil said earlier, which is momentum is your friend, until it's not. So we'll see. Historically speaking, the fourth quarter has been good for stocks, although historically speaking, Q3 is not. So, we do have a different scenario this year. I really believe that AI narrative is not going to go away anytime soon. And if we look at where we're going to see spending in the future, data centers, yes, and then energy. Energy actually hasn't done very well this year. The oil's been kind of up and down and all of that. I do think that we're going to see energy take on as a theme. We're going to get very diverse in our energy policy. We need to build out a significant amount more energy if we are to keep up with these AI demands. So, that's one theme that I kind of watch for a long-term investor, that. And also the unsung hero of sectors, industrials this year, as we've kind of really been forcing companies to reshore. The government's been very activist in saying, you have to reshore a lot of your production. And so that has led to industrials doing very well during this period of time. So will we continue to see that? It looks like the administration likes those wins and the street likes that narrative. So I would say the reshoring sort of theme will probably persist as well coming into next year.
So you talked about the view of the firm, at least one, if not a couple more rate cuts between now and the end of the year. What effect do you think that has, if any? Let's assume it happens, right? So what effect, if any, do you think that has for Q4?
I mean, I think that's going to be part of the story. I think it's pretty much already priced in. So I don't know if it's going to be the main driver.
You think one is priced in? Or
I think at least one is priced in.
Gotcha.
But I think if we see disappointment on that front, that could add a bit of volatility. But I do think that we're going to see lower interest rates on the short end of the curve, so short dated rates. I think what might surprise people is we could also see lower interest rates in the 10-year and longer dated bonds, right? I think there's a lot of talk about government spending and what's happening in the treasury market. But if you look year to date, even the 10-year is down almost 50 basis points, right? And there's a good chance that could continue, and that might surprise people, and that might be part of the next phase of this rally here going into year end.
Which is funny because when people say if you want to know what's going on, look at the bond market. Right. I mean, not that you don't look at the stock market, but I mean, the bond market's really what tells you what's going on within an economy. And it's interesting because it doesn't get the love that it should. But I mean, that's where a lot of your quote answers will be found. Right.
Right. And I think I don't have the numbers in front of me, but I think at the beginning of the year, the 10-year was something like 4.59 or something. Yeah. And it's now just above 4. So,
and it's the reason for lower mortgage rates.
Yeah, absolutely. Right. And, I wouldn't be shocked if we saw a sub 4% 10-year yield sometime in the coming weeks. And, I think that could be part of a broader rally in risk assets going into year end. But we'll see. That is speculative, obviously, but that's kind of one of the potential themes that I look out for.
What's your biggest wrench that you see, the thing that would really upend the rally? Is it a real hot inflation print?
I think a real high inflation print, disappointment with rate cuts. I think that could be really challenging, and it could kind of derail things.
Yeah, sure. I agree with you on that. I think that's the big, aside from the unforeseen sort of thing, or a really, really long-term government shutdown. As we're talking this, I don't anticipate that to happen, but yeah, super hot inflation print might be okay. Now the tariffs have finally come to roost and they're passing that on, even though companies don't appear to be passing on a lot of those price increases to their customers.
Yeah, agree with that.
Well, we always take a long view, Walkner Con, and that's what we do. It's how we do it. It's how we've always done it. But yet, it's at the same time, it's a disservice to our clients if we don't speak about kind of the shorter periods of time. And so we thought this was a good time to talk, especially again with everything that's going on. We will absolutely be doing a year end and a more robust kind of 2025 recap coming here in the next few months. So watch out for that. And if there's any other topics you'd like to hear about, please let us know. You can find links in the description below and ways to communicate with us. We want to speak to you on what you want to hear. So if this was helpful, let us know. And if you want to hear more about just pure economic talk and kind of up to the minute, if you will, topics, we can cover those as well. So until we see you again, we look forward to another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.